Hello. This is Jonathan, and you're listening to the Johnny Talks podcast, the place where we help you achieve your financial goals. Hola, amigos. Hope you're having a great day wherever you are. And if you're a new listener to the show, special warm welcome to you. I really appreciate you tuning into the show. And if you're a returning listener, welcome back. I appreciate it even more. In today's episode, we will speak to Sarry Ibrahim from Finasset Protection. Sarry is a financial professional and a member of the Bank on Yourself organization. He specialized in insurance and in particular whole life insurance. Sarry will give us an introduction to whole life insurance, what it is, how it can benefit you, how you can leverage it with the cash value part, what the risks are, and the differences with term life insurance. I must admit, whole life insurance is a little foreign to me too, but Sarry's explanations were most helpful, and I hope you will be able to evaluate as well if whole life insurance is something for you or not. This episode is for you if, like me, you're curious about whole life insurance, what it is, etc., and wonder if it can be something for you to consider or not. So without further ado, let's hear the interview. Hello, Sarry. How are you doing today?
Hey, Jonathan. Thanks for having me on.
Yeah, great to have you. And where are you calling me from?
From Chicago, Illinois.
Okay, great. And Sarry, I invited you. We are going to talk about not so often talked about subject on the podcast nor on the blog. We're going to talk about whole life insurance. And because you are a specialist in insurance, you've been working several years in the industry. And as well, you're part of a special organization called Bank on Yourself. Can you tell us a little bit more about the organization?
Yeah, definitely. So the Bank on Yourself organization uses a special type of whole life insurance, mainly for the cash benefits, the cash value, rather than the death benefit. So for those of you who are not familiar with whole life insurance, it has two main functions. One is the cash value part, and the second is the death benefit. The Bank on Yourself concept or the Bank on Yourself organization mainly deals with the cash value part of the whole life policy. And this part, the cash value, has a lot more benefits than other places you would store cash, like in conventional or traditional places like checking account, savings, money market, brokerage account. It actually has more benefits that I can definitely get into later on in the podcast. But that's kind of just like an overview of the concept and why it is whole life insurance.
Yeah, okay. And maybe let's start, before we go into the specifics, with what got you into the insurance industry, Sarry.
Yeah, definitely. So I was doing my master's degree. It was a 2-year program, and I was about halfway through it. And I wanted to work in the financial services sector. So I started working with Allstate Insurance in Chicago. And that led me to like different, I transitioned from the auto insurance, homeowners insurance, commercial insurance field to the health insurance and Medicare world, where we dealt with like health insurance plans for retirees, senior plans. And then from there, I was introduced to life insurance. And it caught my attention, not necessarily, because life insurance doesn't sound that like fun, right? Not that.
Especially when you say the death benefit, it sounds a bit weird, yeah?
Exactly, yeah. It's not something, college students jump on, the opportunity to do. But once I learned more about finance, I learned more about the stock market, about investment solutions that people use around the world, and especially in the States. I started to pay attention more to the cash value parts of life insurance. And that's what led me to the Bank on Yourself organization. And I actually found the Bank on Yourself organization. I was just doing some more research for a client. A client asked me to look up life insurance policies for him. I started doing research, and I went on Amazon and I just searched books about life insurance. And then this book came up called The Bank on Yourself Revolution by Pamela Yellen. And she's the author and the founder of the concept, the Bank on Yourself concept. And that's how I pretty much really got involved into the organization.
Okay, very good. And whole life insurance or term insurance, these two are different. We're not going to go into very, very specific right now, but I was just wondering, maybe you can give us a rundown of who it applies to. I mean, does it apply to a single person in their 20s to already have this whole life insurance, or should you wait until you have a family? Does it depend on your income level? Maybe you can guide us through that.
Yeah, definitely. So you can, I mean, in theory, it's more about what you want to accomplish. Like, for example, if you are wanting to build a retirement plan at a young age, or if you want to build your own pool of money that you can access to at any time, regardless of market conditions, I think this will be a really good fit for you. And more specifically, it's about the control of your own money, right?
Mm-hmm.
The banks, they want us to store our money with them, right? They also want us to go to them when we need money. So we're using the banks to store our money and borrow money. But the problem with this is it's on their own terms. When we store our cash in the banks, in most situations, we're earning very little interest or almost no interest. If it's a standard checking account that you use for daily expenses, you're not going to earn any interest on that. If it's a savings account in today's interest world, it's going to be very, very low interest rates. And then also when we borrow, we're borrowing on their own terms. So the interest goes back to the bank and they get to control the terms and conditions of the loans. So we want to do something where we can kind of be in the middle of that, where we can store our money, earn compound interest on our money, regardless of market conditions, and be able to access our money to borrow from ourselves pretty much at any time, regardless of our financial situations. So, in other words, there's no underwriting when it comes to the loans parts of the whole life insurance. Now, to take it a step further, when you have a whole life policy and you have cash value in the policy, you're actually borrowing that money from the insurance company. And there's a specific reason for that. The bank on yourself concept is also known as the infinite banking concept because it's exactly what it is. It becomes you create your own infinite banking system. So, for example, Jonathan, if I have a whole life insurance policy and I have $100,000 in cash value, let's say, for example, I have $100,000 in cash value in the policy,
So
and
is that it's the policy, it's the money I have saved up, or is it like my guaranteed amount, or how do I need to understand that?
yes, so this is the amount of money you would have put into the policy, and that it would have grown at a rate of about 4 or 5% compound interest every year. So let's say to get to that 100,000, you may have spent. It's kind of hard to say because also age matters and where you are it matters. But let's say that $100,000 was accumulated over time from money
Okay.
you put in plus the interest you've earned from the insurance company, a combination of both. So let's say you're at $100,000 right now in cash value, and you want to use $50,000 for a business investment. So instead of going to your cash value and deducting $50,000 from there, you would borrow $50,000 from the insurance company, leveraging your $100,000 cash value. You would take $50,000 from the insurance company, use that for your investment purposes, and then you get to control the amount of time when you pay it back, the time period of paying it back, you get to control that. So let's say you wait 5 years to pay that back, and after 5 years, you paid back the loan to the insurance company, the $50,000 loan, but also you paid some interest to the insurance company, a simple interest rate of 5%. Now you're probably going to ask, why would you do that? Why would you borrow from the insurance company and then pay them interest on your own money? And the reason why is because on that cash value that you have, you've been earning interest and dividends from the insurance company for during those 5 years. During that time, you've been earning interest and dividends. So now after 5 years, you might have spent like $52,000 to the insurance company, 50,000 for the principal, plus about 2,000 for the interest. And then you gained on your policy maybe 165,000. So now there's an arbitrage, a difference, a spread between what you earned and what you spent. That's why a lot of real estate investors use these policies to kind of recycle their money. So they fund the policies, build up the cash value, borrow from the policy, use for real estate investments or for other businesses, and then pay it back. And then when you do it that process, you're always earning interest and dividends, and there's no interruption in the growth of your funds.
Yeah, I see. So the 100,000, when you take out, or you don't take out, when you borrow the 50,000, so your 100,000 serves as a collateral, or how do I need to see that?
Exactly. It's collateral and it continues to compound and grow without the interruption. There's no interruption. It's as if you never touched 50,000.
So then you borrow the 50,000 at a certain percentage for five. which is actually the same as the 100,000, but because of the difference in amount, that's the arbitrage actually.
The arbitrage comes in from, so the insurance company is paying you compound interest on your money, but you're only paying simple interest on your money.
Ah, okay. Yeah.
That's where the arbitrage comes in.
Okay, very good. And sorry, you were going to say something.
Yeah, I was going to say it's also like if you have, for example, a house that you own that has a market value of $500,000 and you don't have a mortgage, you own it free and clear, no mortgage, but you borrow $100,000 from a bank, leveraging your property as collateral, your property is still worth $500,000, right? You just have an existing loan against it. Same thing with the whole life policy. When you have a cash value of $100,000, for example, and you borrow against it, it doesn't deduct or subtract from the cash value. It just has an existing loan against it.
And then, okay, it sounds good. It sounds nice. But then what are the risks linked to that process? Because, I mean, everybody could think, oh, yeah, great. I'm going to save money. Let's say that the 100,000, like your example, it's very simple. And then I take out whatever money for, let's say, redoing my bathroom or my kitchen. And then, okay, my house will be worth more, etc. But what are the risks, especially now we're in the pandemic? I mean, people could lose their job and it would be difficult to pay back that loan. So how do you see that, Sarry?
Yeah, you're right. When you do borrow, you do have to pay it back. It's not free money, you know? You have to pay it back to the insurance company. But I guess the difference would be, or the risk would be not being able to pay it back. But the difference between this method and the traditional cash method or traditional financing is you get to control the terms. So if, for example, you put it in your mind, I'm going to pay back the loan in like a year, but you've lost your job because of the pandemic or something happened, you can extend that now from 1 year to 5 years. You know, you can control the payback period. As long as you're paying it back, you can control the payback period. That's, I think, the advantage using this concept as opposed to other financial vehicles. But I do think that you do have to have the funding process. You have to have the process where you're funding the policy. If you're in a situation where you need to borrow right away and you don't have the funds for whatever you're trying to buy, I don't think this concept will really help you that much, right?
And would you say, for example, you took the example of the property and then you borrow against it? Let's say you have the property and you borrow against it. Is that a better solution than using the whole life insurance mechanism that you just explained, the bank on yourself?
Oh, so if we have both, if we have the whole life policy. Yeah, I would, again, it comes down to the control of your money and also the market conditions. Let's say, for example, you have the house, the $500,000 house, right? You bought it free and clear, no mortgage. And then you also need some liquidity now. Now you need some cash. But let's say because of the pandemic, the value of the home went from 500,000 to 400,000. Now your ability to borrow against the home has been impacted by the markets. It's been impacted by external factors that you cannot control. That's one downside. The second downside is you have to borrow on the bank's terms, and the banks can control the terms of the loan agreement. And then their loan agreements can also be impacted by market conditions. So on the whole life policy, on the whole life side, those two things won't happen. One, the cash value of your policy will not be affected by market conditions. That's a huge reason why a lot of business owners and real estate investors use this concept, is because it's not impacted by external factors like the markets or the stock market, real estate market. The cash value grows at a guaranteed rate every year, a compound rate. Also, your ability to borrow always stays. Back to the example of the house. When you have a house free and clear, for example, and you want to borrow against it, in a lot of situations, a lot of states, different states, different countries, they're still going to want to see like proof of income to make sure that you can pay back the loan.
Correct.
So what if you don't have proof of income? You don't have the ability to show that, then you probably won't be able to qualify for the loan. But on the whole life insurance side, you can take out the loan regardless. They're never going to ask you for proof of income or credit check or credit score to be able to determine if you're eligible for the loan.
Okay, I see. So yeah, it can be helpful, but you need to really study your case and know what you're doing.
Exactly. Yeah, I think this is definitely a very powerful risk mitigation tool. See, in 2008, a lot of real estate investors in the States, they would like buy properties and then borrow against the properties and then buy more properties and kind of just like recycle their money within the properties. So they would fund it and then borrow, fund, and then at very low interest rates. And it was very good for them because they were able to buy more properties, especially rental properties, and have cash flow and pay little interest. But the problem is in 2008, when the markets crashed, especially the real estate market, a lot of banks said, you know what, we're not able to give out loans anymore because the banks lost money. So they're not able to give out any loans. So they had to cut funding. So now a lot of real estate investors had a lot of cash tied up, in the drywalls of homes, just cash sitting there. They weren't able to liquidate it and move with it. And then also, if they were able to borrow, the market values dropped on the homes. So their ability to borrow, that amount also lowered because it's connected to the market values, right? The lower the home is worth, the lower the loan you could take.
Yeah. And Sarry, this is a mechanism. Okay, I didn't hear from it before. Is that very widespread then in the US? Or I know it's possible here. I did some research before the episode. I saw that in France, which is a country where people love to have their whole life insurance. I mean, it's one of their preferred way to invest. It's possible as well to have this cash value part. So you can not withdraw, but you can use the cash part for your own needs in case you want it. So it's possible. Now, my question is, is that often used or for personal needs or for investment purposes?
Yeah, it is often. The problem is that in the U.S., a lot of like Wall Street and a lot of banks and large companies, especially companies who like trade, have mutual funds and stock options for consumers. They have written a lot of blogs and have a lot of stuff on YouTube and Google, a lot of social media that kind of goes against whole life insurance. So even if you go to Google right now and you search like, is whole life insurance a good idea? You'll see a lot of articles pop up saying no, whole life insurance is a bad idea. And they say like it's too expensive, the cash grows very slowly. But those things are not true because they're talking about traditional old whole life insurance from over 100 years ago and the way they were designed a long time ago. So I'll give you a further example. Imagine this. Imagine you came to me and you told me, I want you to build me a house that's 4,000 square feet. I know you don't use feet, but
I know the conversion. It's about 10, so it's about 400 square meters.
Okay, 400 square meters.
So it's quite, for our standards, it's quite large. Yeah.
Okay, let's say I built you a 400 square meter home, but it was entirely the basement. That wouldn't really help you, right? You would just have a huge like underground house.
Yeah.
But let's say I took that 400 square meters and I divided it like by 2. So now it's 200 in the foundation, in the basement, and then 200 up top now. Now it's going to be more of a reasonable house, right?
Yeah.
Because it's higher up now. Same thing with whole life insurance. If you put $1,000 a month into a policy and that $1,000 a month went directly into the base of the policy, it's not going to grow very much. It's not going to be an appealing policy. It's not going to really help you attain your goals because the cash value part is going to be so small and almost not visible. But if we split it, if we did $500 towards the actual whole life part and then $500 towards something called the paid up additions part, this is the cash value part, the component of the policy. If we split it, now we do half whole life and then half towards the cash value. Now you're going to have almost something that can compete with other investment vehicles. So in other words, it's not just about the amount of square meters or square feet. It's about how you leverage it. Same thing with whole life insurance. It's not just about, is it whole life insurance versus the stock market versus the real estate? It's how you structure the whole life insurance that makes the biggest difference. And I think that a lot of people, especially in the States, they don't know the intricate parts of the whole life policy. So they'll go to Google, they'll search, is whole life insurance a good idea or bad idea? And they'll just say bad idea, no cash value, and they'll believe that. So I think you need to do your homework and you need to kind of look at more resources and more content and look at who's saying it. For example, if a mutual fund company is saying whole life insurance is a bad idea, they're saying that because they want you to invest more money in their mutual fund. Same thing with banks, same thing with large financial institutions have a very tight grip over the media and over social media because they have a lot of money to invest into those platforms. So again, you need to do research and figure out. Another thing, Jonathan, too, is if you really want to identify the truth, look at what large banks do. In the US and in Canada, 80% of a bank's tier one capital. So banks, when they register or become chartered financial institutions, they have to go through like a regulatory process, right? And I'm sure the same in Europe. You have to go through a process to prove your net worth, to prove how much cash you have. 80% of that for banks is located in whole life insurance. And the reason why is, for example, if I'm a bank and I have $1 billion that I'm ready to fund a bank, I'm going to put 80% of it, so $800 million in a whole life insurance policy. And then from the policy, I'm going to borrow from the insurance company and then lend that money out to credit cards, car loans, home mortgages, business loans, and then earn interest in two places: earn interest from the insurance company and earn interest from the consumers and the borrowers at the same time. This is exactly what banks do. So we should mimic what banks are doing instead of just listening to them, right?
Yeah, no, I totally join your point here. The thing is that, every time I see an article, I'm always a bit looking at it with two perspectives. Okay, why do they advise this product? Why does the banker say, hey, you should look at our mutual funds or whatever? Because then, okay, what do they have to gain from it? I mean, because the bank employee, which is the concrete example for me, you go to the bank and you ask for advice, they will recommend a product, but they are working for the bank, not for you, even though it sounds like that. So it's always a bit, there are honest bankers out there, but yeah, you always need to make the balance for yourself. I totally join you there. The thing is with the whole life policy, and it's a bit tricky, I think, to really look at the fine print, to really understand what it's all about, how you can leverage that cash value part, which you explained. So, okay, of course, people can look at you, Sarry. I will put your contact details in the show notes and everything. But where in general can people find information? For example, okay, people here in Europe, they may say, look, it sounds interesting. I listened to the episode. I'm willing to know a bit more about it and to make better use of my whole life insurance. Who should I ask, actually? Because then it's very difficult for them. Let's say a guy in France, a guy in Belgium or in Germany, he says, yeah, look, I'd like to talk to a local specialist.
Yeah, definitely. I could definitely help. My colleagues and I can help people in Europe. There's ways to do it. There's ways. It's not going to be guaranteed that we can get policies finished for people in Europe, but there are ways to do it, and everything could be done via Skype or Zoom. So the communication is no problem. As far as getting more information, you should look up Bank on Yourself concept, the infinite banking concept. Also, there's a lot of books. Just Google books or go to Amazon, search for books about the infinite banking concept by Nelson Nash. Also, the Bank on Yourself concept by Pamela Yellen. You'll find a lot of information that talks about what banks do. So other names for are like family banking, circle of wealth. But pretty much, you're going to remember infinite banking and Bank on Yourself, and look for resources that, like you said, don't have a bias, agenda. They're not selling you, like the bank telling you to invest with them because they're saying, they wrote the article or the banker saying that.
Yeah. I've noticed some of those in the articles, whatever the topic is, when it's written by a bank here with they have their blogs. It's great, but sometimes it's like, what's behind it? And
right.
Yeah, don't want to be a hater, but yeah, sometimes you just need to look between the fine print. And then I have maybe one last question on the topic for you, Sarry, because I've read a few blogs myself a long time ago, and I read, of course, blogs in Europe, blogs in the US. And when I saw the topic of whole life insurance, they often compare it. I mean, bloggers or the reviewers, they compare it to whole life insurance and term insurance, term life insurance. So can you just maybe give a quick example or quick explanation on what the differences are? Because I've seen a lot of recommendation for term life insurance.
Yeah, definitely. Yeah. So the difference between term and whole life. Term insurance is like, imagine you rent a home, right, for 10 years. You pay monthly rent. And then after 10 years are over, you walk away, you move out of that home now, right?
Yeah.
You don't have any equity. There's no ownership. You don't get any cash back, right, from the rent you've spent over those 10 years. Same thing with term insurance. Term insurance is like you're just using the life insurance only, the death benefit only, for a finite period of time without any cash value or equity built into the policy. So it's either 10 years, 20 years, or 30 years. and it's only the death benefit. So I'll get it for 10 years, pay monthly on it. And if nothing happens to me within those 10 years or within those 20 years, then I just walk away. The insurance company keeps the money and nothing happens after that. And a lot of people would say to go with term insurance over whole life because I think the average difference is about 20% the cost. So in other words, whole life insurance is 5 times the cost of term insurance because there's no cash value, there's no dividends involved, there's no interest, compound interest you receive from the insurance company. So it's just straight life insurance only with a death benefit. And a lot of people, a lot of banks, actually, mutual fund companies will say to use term insurance and then invest the difference in the stock market. So, for example, let's say that you put in your mind, I have $1,000 a month to use. The mutual fund companies and the banks would say, put $200 a month towards term and life insurance, or maybe even less, maybe $100 a month towards term life insurance, and then put $900 a month in the stock market or in a mutual fund, because you would get a much higher return on your investment doing it that way, and the insurance would cost you much less than putting in whole life insurance. But of course, I have objections to that. I don't agree with that method. Number one, because of market risk and volatility. If I put in $800 a month towards a mutual fund, yeah, there might be returns, but also there might be losses. The banker or the advisor can't guarantee my growth on my money. The banker or the mutual fund advisor can't say in 20 years you will have X amount of dollars. It's actually illegal for them to do that. They can't guarantee in 20 years you'll have X amount of money because they have no idea what will happen in the markets.
Correct.
So that's one huge downside. Also, the term life policy. I know for a lot of people, the life insurance part is not appealing. It's, we're more concerned about the cash value, but eventually you will have to acknowledge the death benefit part, especially when you grow older, when you're in your 60s and 70s and you have children or grandchildren, you have businesses, you need a financial vehicle that will take what you've built and pass it on to the next generation. And a lot of situations, tax-free. In the US and Canada, the life insurance proceeds are tax-free. So a lot of wealthy people, of course, who have been building up their empires want to pass off their empire, what they built, to their families tax-free. So if you did the term insurance, let's say you are 40 years old and you did a 20-year term policy and it ends when you're 60. Now to renew it, you have to go through medical underwriting again. The problem with this is, what if your condition changes in 20 years? And it does for a lot of people between the ages of 40 and 60. A lot of people go through different conditions. Now you might get denied the insurance. I'm not saying you will, but it could happen. You can get denied insurance now. Now you can't, or it might be super expensive, maybe 10 or 20 times what it cost you 20 years ago. The price would jump that dramatic. So those two issues, number one, the market volatility, number two, being unsure of your health in the future, those two things are the downsides to using that term and invest the difference.
Yeah. Okay, very clear. I mean, it's still, I think it's a lot of information. And even for me, I will tell you, I have no whole life insurance on myself, but I have no kids. So I'm mostly invested in the stock markets and real estate. So this is what I'm doing now. But of course, I think if kids come and stuff like this, okay, I will start to look at more seriously at all this term insurance and whole life policies, of course. And Sarry, look, I think we've come at the end of the show, and I want to thank you because it's not an easy topic. I think it's very difficult, and it's not very difficult. I think it's a bit tricky for people to get it. It's not that complicated, but it scares off people. You say whole life insurance and everybody's gone. So I wanted to thank you for trying to make it as clear as possible, and you did a very good job. So thank you so much. I think it brings a lot of value. And what I wanted to say as well, just now I remember, is that this tax advantage that you mentioned, it's also valid in France. I mean, I don't know if it's totally tax-free. I will not do not quote me on that, but I know there's a lot of tax benefits when using the whole life policies for succession. Mm-hmm. So it's important to say. And Sarry, as you know, we come at the end of the show. We always have our 3 quick fire questions. So are you ready?
I'm ready.
You're ready? Good. So my number 1 question is, what has been your best investment so far?
So far, my best investment was going to graduate school to get my master's degree.
Mm-hmm.
I don't think that you need a master's degree at all to be successful in business. So I don't believe that. But I think just the process of doing it has really helped me a lot.
Yeah, no, I agree. I mean, like education, and it's you don't only learn what's in the books. You learn how to study. You learn it's a way of thinking. Huh?
Exactly. Yes.
So I mean, for me, I studied business as well. What I get the most is I got a toolbox which helps me further, and I will never say, "Oh, college is stupid" or anything. So, in my case, I'm very happy with my education. So, kudos to you, excellent investment, Sarry. And then number 2, you already recommended a few books, but I want to ask you anyway: what is one book you can recommend to anyone, and it does not need to be a financial book?
Yeah, definitely. Yeah. So the book called Mindset by Carol Dweck.
Okay.
It has nothing to do with finance, but I think it's really good, especially if you are becoming an entrepreneur or you're already an entrepreneur. The book pretty much just talks about differentiating between having a fixed mindset and a growth mindset.
Oh, great. Yeah. Okay. Yeah, good.
Really
good. Okay, very good. I'll link it all up in the show notes anyway, so people can you can all look at it and see if it's for you. But yeah, if it's promoting the fixed and the growth going from a fixed to a growth mindset, I'm all for it.
Mm-hmm.
And then the last question, Sarry, what is the best purchase you've made for under $100?
The best purchase recently I've made under 100 is hiring offshore virtual assistant.
Mm-hmm.
She has helped me a lot, and yeah, pretty much that's the best investment I've made so far.
Yeah,
under $100.
so it saves you a lot of time and hassle and things.
Exactly. Yes, absolutely.
Okay, yeah, excellent. And yeah, well, Sarry, if people want to know more about you, or if they have questions on whole life insurance in the US and abroad, how can they contact you or find you?
Yeah, you can go to finassetprotection.com. That's FIN assetprotection.com.
Okay, excellent. So everything's there. So I'll link it all up in the show notes. And then, yeah, Sarry, I want to thank you again for coming on the show today. It was great.
Thank you, Jonathan. Thanks for having me on.
I hope you enjoyed this episode and that you learned something new today. I certainly did. I was really not aware about all this cash value and banking on yourself concept. At least it gave me a little introduction to it. And of course, this may or may not be for you, but still, I think it's important to bring different perspective here on the podcast, and then it's up to you to decide if it's for you or not. So of course, as usual, always do your own research and consult with a professional to see if it's the right thing for you. Anyway, before we head off, here are the key takeaways for today. Number 1, whole life insurance has 2 main functions: death benefit part, which we all know about, and the cash value part, which was the main topic of today. Number 2, for whom is this whole life insurance? Well, this can work for people who want to start planning their retirement at a young age, or for others who want to build their own pool of money, which they can control regardless of the market conditions, and in general for people who earn a stable income. Yeah, because if they're going to take a loan on themselves, well, they need to be able to pay it back, regardless of the benefits presented in this podcast. Number 3, about the risks. Well, I asked Sarry, what about the risk? And then he told us, well, in whole life insurance, if you take out a loan from your cash value part, well, you can control the terms of the loan. Meaning that if you cannot pay back within a year, for example, you can extend the payback period, which is one of the advantages compared to a bank because they control the terms, for example. But of course, this mechanism only works for people who have been able to fund their account. So if there's nothing in the fund, well, you cannot borrow against it. And last but not least, if you feel whole life insurance is something for you, well, do your homework, do some research. I've also linked a few articles in the show notes to help you, and eventually consult with a professional. And don't forget, everyone has a bias, be discerning, as we discussed during the episode. And personally, for me, I'm not convinced this is something for me. With regards to investing and growing my money, I prefer the volatility of the stock markets for now, because I'm in it for the long term. So this is my choice, but you need to figure out what's best for you according to your risk tolerance and your time horizon. So that was it for today. Thank you so much for listening. It really means a lot to me. Make sure you subscribe in Apple Podcast. And of course, please do not hesitate to contact me. If you have any questions or feedback, send me an email, john@johnnytalks.com, or connect through social media at Johnny Talks on Facebook, Twitter, and Instagram. And amigos, once more, thanks so much for listening, and I'll speak to you next time.